Hello student, my name is Dr. Athar Iqbal, and in this stock valuation lecture we will cover how to calculate stock prices when we assume that there is no growth in company stock. Remember that there are various situations which is possible in company stock valuation. The one fundamental concept that is applied on the Gordon dividend discount model is that when we assume that the company has no growth in future, then what are the requirements to calculate the price of this kind of a stock. So in this lecture we will able to understand how to calculate stock prices by applying Gordon dividend discount model. As you understand the previous symbols, so based on those symbols we will continue our chapter. So student, there are three different approaches that might be used depending on the company data which is given in the question. The first one is called zero growth model. Zero growth model can only be applied when company is not showing any growth in terms of its earning and dividend. The second approach which might be applied depending on the question data is called constant growth model. Constant growth can only be applied when question or the available data is showing that the company has constant growth. If constant growth is given in the question, then we can use this model. And the third approach which might be applied is called supernormal growth, where the dividend growth is fluctuating. Sometimes it's going on a higher side or on a lower side, or company is not paying any dividend for a certain number of years. So in all these three cases, we will be dependent on what data is available or what type of company we are valuing right now. So first showing you the zero growth model, where we assume that the company has no growth in future. So you own a stock that will start paying $0.5 annually at the end of the year. Remember that this is the dividend which is given at the end of the year. So you can recall that what symbol you can use for this information. It has zero growth in future, which is specifically given in the question. It means that we can apply zero growth model. If the required rate of return is 14%, what should you pay for this share? So first of all, we will see that what data is available and what symbols we can use for these informations. So as discussed in the previous lecture, based on that, we already know the symbols that might be applied over here. So showing you again, this is the data which is available. Question is giving you D1. Remember that we use D1 when we say that this is the dividend which will be paid by the company at the end of the year. P0 is the current price which is required by the question to calculate, and the investor required return is 14%, and for this we have taken RI as a symbol. So based on this data, we will apply the formula of dividend discount model. So P0 is depending on D1 upon R. It's up to you to decide whether you are using in a small R or you are using a capital R, depending which is more appropriate for you. P0 is depending on D1 upon R, and as you can see, D1 is given in our question as well as R is also given in the question. So we will put in the formula. So 0.5 is the dividend which is given and 14%. So again, it's up to you to decide whether you are writing 14 in terms of percentage, or for simplicity, you can write it as 0.14. I would prefer if you write it 0.14 because it will give you much comfortable environment to calculate it from your calculator. Once you will take 0.5 and you will divide it by 0.14, your answer will be 3.57. So 3.57 is the fair value of this stock. And again, reminding you, it is depending on the market price. Sometime market price will be higher than this one, and sometime it is also possible that the price in the market is lower than this price. But this is giving you a fair value from an investor who is applying Gordon dividend zero growth model to calculate it. Just look at this question. You own a stock that will start paying $3 annually at the end of the year. So again, remember that this is the dividend which will be paid by the company at the end of the year. it has zero growth in future. It means that we can again apply the same formula over here. If the current price of the share is 50, it means that now the stock price is given, and question is asking what will be the implied required return of investor. So in all the cases wherever we are applying zero growth model, first we will see that what data is available. So this is the information which is given in the question. D1 is available 3, as you can see over here. P naught is given 50, which is given in the second line. Recall that why I am writing P naught, because current price. If you will go back to the previous lecture, you can find that there are various symbols that I discussed in the previous lecture. And for the current price, we can use P naught. And for the next year price, we can apply P1. R is required by the question. So you will use the same formula that you used earlier. Now apply the given information. So you will see that P naught is given in the question. D1 is also given. Ri is required by the question. So those students who are mathematically sound and they can apply the cross multiplication, then they can find it. So cross multiply it and get the answer. Might be you will be getting answer of 0.06 on your calculator, or you can convert this information by multiplying 100. So you can get 6%. Now suppose you bought a stock today at 40 per share. So this will be taken as P naught. Required rate of return is given 12%. What dividend will you receive from this stock? It means that we are still applying the same formula, but only the information is changing in the question. So now if you take these two information and interested to find out dividend, so first look at the data which is given in the question. D1 is the information which is required by the question. P naught is given 40, which is available here, and investor required return is 12%. So again, we will use the same formula. Now when you will fill it, you will see that P naught is given and D1 is required by the question. So when you take this 40 and multiply by 0.12, then you will get the answer of 4.8. And this 4.8 is the dividend which will be paid by the company at the end of the year.